Alright, good day everyone. Today I'm Venkatesh Parameswaran. I would like to present on the group assignment for my Managerial Financial for Set 2. So the group assignment is for us to choose two stocks and do a data analysis. So I and my teammates have choose two stocks, which is Bumi Armada and also Hibiscus Petroleum for our assignment, which gives us the analysis of the data for us to look into their financial stability. So before I proceed further, I would like to tell about the introduction of these two stocks, which is Bumi Armada and Hibiscus Petroleum. So Bumi Armada Berhad and Hibiscus Petroleum Berhad represent two major but fundamentally different segments of Malaysia's oil and gas industry. Bumi Armada operates as an offshore service provider supplying long-term FPSO, which is called the Floating Production Storage and Offloading Solutions, marine services and engineering support to global energy operators. Its business model is anchored on multi-year service contracts, giving the company relatively stable and predictable revenue streams. This structure allows Bumi Armada to sustain operations even during periods of oil price volatility, although its performance can be affected by operational risk, contract renewals, and legacy debt issues. Hibiscus Petroleum, on the other hand, is positioned firmly in the upstream exploration and production space. Its earnings depend heavily on crude oil prices, production volumes, and the success of field development projects. As an independent E&P company, it is more exposed to market cycles, yet also more capable of capturing upside gains during periods of high oil demand and rising commodity prices. This creates a business profile that is more volatile than Bumi Armada's, but with potentially much higher returns during strong commodity cycles. The analysis of both companies based on the data that our professor have given, it can be said that from 2018 to 2022, the analysis captures a period marked by intense financial challenges, including Bumi Armada's heavy impairments in 2018 and the global economic shock caused by the COVID-19 pandemic in 2020. By examining share price trends, profit performance, stand-alone and systematic risk portfolio diversification benefits, valuation ratios, and CAPM-based alpha, the data analysis aims to understand how each company navigated volatility and what their performance indicates for investors. The 5-year dataset reveals contrasting paths, one driven by a turnaround in contract-based earnings and the other powered by cyclical commodity exposures, providing a comprehensive foundation for evaluating the risk-return characteristic for both the stocks. So my teammates will be explaining in detail the data analysis that they found from both the stocks. So I will leave it to my teammates to present the next on the stand-alone risk. Thank you.
Hello everyone, let me introduce my part. Explanation. My analysis evaluates the stand-alone risk of two Malaysia oil and gas company Bumi, Armada Berhad and Hibiscus Petroleum Berhad, using mostly written data from 2018. Stand-alone risk is measured by the standard duration of returns, representing the total volatility of each stock when considered in isolation. then calculations. Bumi Amada. Average monthly return 1.73%. Monthly standard deviation 20.28%. Annualized volatility 20.28% times square root 3 equals 70.27%. Hibiscus petroleum. Average monthly return 2.31%. Monthly standard deviation 16.99%. Annualized volatility 16.99% times square root 12 equals 58.55%. Comparison. Hibiscus has lower stand-alone risk than Bumi Amada. Both stocks are highly volatile. Compared to the KLCI, market volatility of 18.67%. Hibiscus offers a higher return with lower risk, suggesting a better risk-return prolongation on a standalone basis. Conclusion: then, when Bumi Amada is significantly riskier than Hibiscus, with higher volatility and great exposure to market and firm-specific shocks. Then, to Hibiscus petroleum, where still risky, shows more stability and a more reductive risk-return trade-off. Next, 3 both stocks carry high total risk, which includes systematic risk, unsystematic risk. For undiversified investors, holding either stock alone is risky, but Bumi Amada is especially volatile. Fifth, diversified investors should focus on systematic risk beta, as unsystematic risk can reduce slow portfolio diversification. That's all. Thank you.
Hi, Doctor. Today I'm going to explain my portfolio risk analysis. I used 2 Malaysian energy stocks, Bumi Armada and Hibiscus Platinum. I'll read it BA and HP. My purpose is to see the return and the risk when we put them together in one portfolio. First, I choose an equal weight portfolio. That means I invest 50% in BA and 50% in HP. Next, from the monthly data, the average monthly returns are BA 1.33% per month, HP 2.31% per month, because returns grow with compounding, I convert monthly return to annual return using 1 plus monthly return power 12 minus 1. So for BA, the annual return is about 22.75%. For households personal loan, the annual return is about 31.42%. After that, I calculate the portfolio expected return. Since both weights are 0.5, I just take the average portfolio return equals 0.5 times BA annual return plus 0.5 times absolute annual return. So the portfolio expected annual return is about 27.09%. Now I talk about risk. Risk is manifold by variance and standard deviation. For the data, BA monthly variance is 0.04113. HP hibiscus per trillion monthly variance is 0.02854. Then I calculate covariance and correlation. The covariance between BA and HP is 0.00762. Correlation equals covariance divided by standard deviation of BA times standard deviation of HP. After conclusion, correlation is about plus 0.2223. This is a low positive correlation. It means the two stocks sometimes move in the same direction, but not very strongly. So the version I can reduce risk a little bit. Finally, I calculate the portfolio and direction. The simplified idea is portfolio risk equals the square root of BA white security times BA variance plus HP white security times HP variance plus 2 times BA white times HP white times covariance. After putting in the numbers, the annual portfolio standard deviation is about 50.46%. And finally, conclusion. So my final result are portfolio expected annual returns is about 27.09%. Portfolio annual risk is about 50.46%. Correlation is low positive 0.2223. So deviation helps a bit, but risk is still high. That's my explanation. Thank you, doctor.
Okay, my part is optimal weight of Bumia Mad, Bharat BN, and hibiscus petroleum Bharat portfolio. The optimal weight is determined by calculating the minimum variance portfolio with MVP, which aims to minimize the portfolio risk volatility without considering expect returns. The formula for the optimal weight of BA, the MVP is W mean BA. Opening Kawi arenas, Bunyamada, Sigma, Bunyamada, Sigma. Using the poverty date. Variance of BA monthly returns, Sigma Bunyamada 00413. Variance of HP monthly returns, HP 002854. Koreas between BA and HP cover BA HP person 0.00762. Calculation W mean BA 002854 00762 00413 00284 2 person 03843. Just the optimal weight is Boni Ahmad Bahad 3843%. Hibiscus petroleum Bahad 57%. Key factors information the optimal weight lower variance of HP. HP have a lower variance 0.2854 compared to BA. According to portfolio theory, it sides with lower variance contribute at less to average risk, so they are assigning a higher weight in the MVP. Low positive covariance, the covariance between BA and HP is low and positive 0.00762, indicating a weak positive correlation between their returns. This allows for partial risk diversification, but the weakness difference remain the dominant fact. The minimal visible portfolio able to Bini Amanda behind and to his base perfect behind. This allocation meaning this the portfolio's relativity to impactivity 59%, which is seen for which is significantly worse of both stock for risk average inverters. The opener way provides the lowest possible risk for this two stock portfolio with still capture the returns from both assets. Okay, just my part.
Hello everyone, it's my part. The beta coefficient of Bumi Armada behind and Ibiscut petroleum and consequent and measurement of beta. The beta coefficient is a foundational indicator used to measure the systematic risk of an individual stock relative to the overall market, and it represents the sensitivity of a stock's return to movement in the market portfolio and is a key variable in the capital efficient pricing model (CIPM). Mathematic beta is defined as beta is called RIM, where RI is the return of the individual stock, RM is the return of the market index, COV is convenience between the stock and the market returns. VR is the variance of market returns. Interpretation of beta value. Beta is 1, is moves in line with the market. Beta bigger than 1, more volunteer than the market. Beta lesser 1, less volunteer than the market, and beta lesser 0, inversely related to the market, and the matrix. The first line is matrix. Bumi Armada, Hibiscus petroleum is HP, and KLCI is market RI. The first line is mean return 1.73%, BA 2.31%, HP, NA, KLCI, and the second line is variance 0.04113, BA 0.02854, HP, 0.0029, KLCI, and the third line is annualized return 22.75%, BA 31.42% HP, 9.19% KLCI, and the first line is convenience. Call BA HP is 0.00762. Call BAM is 0.00393. Call HPM is 00192. Estimated beta for Bumi Armada and Hibiscus, particularly A. Bumi Armada, input data from early session of the report. Beta estimation. Beta A is call AIM, whereas IM is 0.00393, 0.00290 is 1.35, and the convenience term shows that when the market returns were positive, Bumi Armada's returns tended to be positive and relatively a plan fund with reflected in a high beta. B. Hibiscus return beta estimation. Beta H is 0.00192, 0.00290 is 2.66. The convenience term here is loser, indicating that Hibis petroleum returns more less in sync with the overall market than Bumi Armada's, which is a characteristic of a low beta stock. And the conclusion is Bumi Armada inhibits a beta of 1.35, classifying it as a clinical and adjusted investment. A beta greater than unit indicates that the stock is expected to amplify market movements. Specifically, if the KLCI raised by 1.0%, Bumi Armada is impacted to raise by 1.35%. Conversely, during a market downturn, this high sensitivity means the stock will disproportionately magnify losses. This high beta suggests that the factor during Bumi Armada's returns, less is the global FPSO contract the success and recovery narrative are strongly tied to the general macroeconomic and market sentiment. From a strategic perspective, Bumi Armada is best suited for investors with a strong bullish outlook on the Malaysia market, who are willing to accept invited systemic risk in pursuit of higher returns. In contrast, Hibiscus petroleum record a beta of 0.66. Designating is having lower than Avenger systemic risk. Since its beta is less than 1.0, the stock is expected to damage market movement, 1.0 percent change is KLCI is projected to result in online 0.66% change in hibiscus petroleum's Purance. This indicates that its performance is driven less by broad market sentiment of more by industry factors. Primaries, commodity price volatility, successful explosion and production result, and geopolitical events specific to the oil sector. This law systematic risk portfolio means hibiscus petroleum valuable differences commented within a diversified equity portfolio as it provides a measure of stability during periods of general market turmoil. The stark difference in beta confidence requires two separate strategic consideration. From maximum implosion to market motion, an investor should allot capital to Bumi Armada. However, for the crucial goal of portfolio risk management, the lower beta of hibiscus petroleum is indispensable. The combination of a high beta stock and a low beta stock provides an operator to construct an efficient portfolio that matches the balance between aggressive systematic explosion (BA) and defensive relative stability (HP), allowing the investor to tailor the portfolio's overall beta to match their risk tolerance.
The section centers on the security market line (SML) analysis of Bumi, Armada Berhad, and hibiscus petroleum Berhad. It assesses the risk-return alignment of the two companies using the capital asset pricing model (CAPM) with key details as follows. The first, basic parameters: risk-free rate (RF) 3.59%, market return (RM) 9.19%. Beta, a measure of systematic risk, 0.73 for Bumi Armada, 0.49 for hibiscus petroleum. Second, SML calculation. The core SML formula is ER equal RF plus beta multiplied by RM minus RF. Using this, we derive the required returns. The market demands based on each company's risk. Bumi Armada 3.59% plus 0.73 multiplied by 5.60% approximately equals 7.68%. Hibiscus petroleum 3.59% plus 0.49 multiplied by 50.60% approximately equals 6.33%. Third, alpha analysis. Alpha reflects the gap between stock's actual historical return and its SML required return. A positive alpha indicates the stock is and valued or outperforming market expectations. Bumi Armada actual return equal 15.58%. Alpha equal 7.90%, and valued outperforming. Hibiscus petroleum actual return equal 25.59%. Alpha 11%. Alpha equal 19.26%. Highly undervalued strong outperformance. First, company specific characteristics. Bumi Armada with a low beta. It carries low systematic risk. However, its actual return doubles the CAPM's expected return, driven by internal operational improvements such as effective FPSO contract management. It is well suited for risk average investors seeking returns that outperform the market. Hibiscus petroleum boasting a low beta. It has a low market sensitivity, yet its actual return exceeds 25%, fueled by oil price cycles and operational leverage. It faces high risk, high reward investment portfolios. Conclusion: the SML analysis yields three key findings. Both companies' actual returns significantly surpass their risk-matched required returns, leading to substantial positive alpha. This indicates, first, the market has historically and valued both stocks. Two, the excess returns stem from idiosyncratic factors, specifically Bumi Armada's operational turnaround and Hibiscus petroleum's exposure to oil price fluctuations plus strategic acquisitions. Third, for both firms, the rewards have vastly outpaced the market's required return relative to their level of volatility. That's all. Thank you.
I will continue briefly present the growth of key valuation metrics for Bumi Armada Berhad and Hibiscus Petroleum Berhad over the period 2018 to 2022. My focus is on EPS, PE ratio, dividend yield, and net profit growth. Based on data from annual reports and historical stock prices. First, for Bumi Armada, Because the company reported a net loss and negative EPS in 2018, we start our growth comparison from 2019. From 2019 to 2022, both net profit and EPS improved, and the share price increased from around 0.40 to 0.58. Over the same period, the P/E ratio stayed quite stable, moving only slightly from 3.73 to 3.93. This tells us that the rise in share price was broadly in line with the growth in earnings. So, the market kept valuing the company at a similar multiple. However, Bumi Armada did not pay any dividends in these years. So, investors did not receive income returns from this stock. Next, for Hepicos Petroleum. Here, we also face a year with negative net profit and EPS in 2020. So, we measure growth between the profitable year 2018 and the strong year 2022. The results are very striking. Hepicos shows about 63% CAGR in net profit and 54% CAGR in EPS over this period, meaning driven by the recovery in oil prices and successful expansion of operations. The difference between these two growth rates is explained by an increase in share outstanding in 2021. The P/E ratio for Hepicos is much more volatile. It drops from 15.73 in 2018 to only 3.39 in 2022. This sharp fall means that earnings in 2022 grew much faster than the share price. So on 2022 numbers, the stock looks very cheap. At the same time, the dividend yield recovered to about 2.50% in 2022, slightly above the 2.36% level in 2018, which suggests management is confident about future cash flows and is willing to return cash to shareholders. To conclude, Bumi Armada shows steady recovery with stable valuation but no dividends, while Hepicos Petroleum shows much faster growth, a cheaper P/E in 2022, and a restored dividend yield from a pure growth and income.
So, back to the conclusion part after the calculation of the data analysis of both stocks. The key observation from the analysis, we can see that Bumi Armada and Hibiscus Petroleum over the 2018 to 2022 period reveal several important observations about how each company's business structure influences its financial behavior, risk profile, and valuation. Bumi Armada demonstrated a steady and disciplined recovery after its major impairment in 2018. The company's long-term FPSO contracts supported a gradual rebound in profitability, resulting in consistent improvements in earnings and a relatively predictable earnings trajectory. Despite this, the market remained cautious, where it reflected in a persistently low profit earning ratio, indicating lingering skepticism about its long-term growth potential and concerns about debt and asset aging. Yet, performance relative to its systematic risk shows Bumi Armada delivered returns far above what the market expected, suggesting it was materially undervalued throughout the period. So, meanwhile, Hibiscus Petroleum displayed a very different pattern. Its earnings and share price were highly sensitive to fluctuations in global oil prices. This resulted in sharp swings, losses at the height of the pandemic, and exceptional growth when prices rebounded in 2021 and 2022. Even though its standalone risk was high, the stock carried surprisingly low systematic risk, meaning its volatility was driven largely by oil price movements rather than broader market forces. The combination of strong earnings surges and a low profit earning ratio created a situation where Hibiscus appeared drastically undervalued, and its extremely positive alpha confirmed that the market had consistently underestimated its growth potential actually. So, based on these two companies, it's generated substantially positive alpha, indicating that it significantly outperformed the market's required return based on their betas. So, for investors, the contrasting nature of their risk drivers, contract stability for Bumi Armada and commodity exposure for Hibiscus also provided a meaningfully diversification benefits when combined into a portfolio. The optimal portfolio mix achieved notably lower volatility than holding either stock alone, highlighting their complementarity. Yeah, thank you. So, I would like to proceed with the final thoughts of Bumi Armada and Hibiscus Petroleum. With the analysis that we have done, so the combined analysis of Bumi Armada Bharat and Hibiscus Petroleum Bharat from 2018 to 2022 presents a compelling narrative of two companies that differ sharply in business model yet jointly deliver unusual strong investment characteristics when viewed through risk, return and valuation metrics. The quantitative findings, ranging from standalone volatility, systematic risk, alpha and minimum variance portfolio weights provide deeper insight into why both stocks were significantly undervalued relative to their performance. So, Bumi Armada demonstrated the financial profile of a company undergoing a structural turnaround. After recording a massive loss of 2.31 billion in 2018, the firm transitioned into steady profitability with earnings rising to 871.2 million in 2022. Its earning EPS improved from negative 0.39 in 2018 to the positive of 0.1475 in 2022, and its profit earning ratio remains consistently low around the range of 3.7 to 4.1. This valuation suggests that even as profit recovered, the market continued to harbor doubts, likely due to the company's historical impairments and debt concerns. Yet the data reveals that Bumi Armada delivered far more than the market had expected. Its annualized return of 22.75% significantly exceeds the 7.68 return required by the security market line for a stock with its beta of 0.73. This produced a positive alpha of 7.90%, confirming that the stock outperformed its risk adjustment benchmark. Its risk behavior reinforces this undervaluation. Although the company had a high standalone annualized volatility of 70.27%, its beta of 0.73 shows that only a moderate portion of this volatility was systematic. Much of its risk came from firm-specific issues rather than market-wide forces. This combination of modest beta, rising profitability, and strong alpha positions Bumi Armada as a defensive yet undervalued asset, ideal for investors seeking stable, contract-driven cash flow with long-term upside. So now let's move on to Hibiscus Petroleum. By contrast, it displayed a performance profile shaped by commodity cycles. Its earnings swung from a loss of 302 million in 2020 to a remarkable profit of 649 million in 2022. The EPS similarly surged to 0.3241, driving the profit earning ratio down to a very low 3.39, where this is a sign that the market believes such a high earnings were unlikely to be sustained. Despite this skepticism, Hibiscus delivered an exceptional annualized return of 31.42%, dramatically outperforming its CAPM required return of only 6.33% based on its beta of 0.49. The resulting alpha of 19.26, which is a positive value, represents one of the most significant findings of the analysis. Hibiscus generated returns almost 4 times higher than what the market deemed fair for its level of systematic risk. Its risk structure further explains why this alpha emerged. Although Hibiscus exhibited a high standalone volatility of 58.55%, its beta of 0.49 shows that its volatility was largely unsystematic. The company's performance was shaped more by oil price movements and company-specific developments than by general Malaysian market trends. This made Hibiscus an unexpectedly defensive stock in systematic terms, despite being operationally exposed to global oil fluctuations. For investors seeking high return without proportionate exposure to market movements, this low beta, high alpha combination made Hibiscus especially attractive. When the two stocks were evaluated within a portfolio, the benefits became even clearer. Their correlation of only 0.2223 allowed substantially diversifications. An equal weight portfolio delivered an annual return of 27.09% while reducing volatility to 50.46%, far below their individual standalone risk levels. The minimum variance portfolio further refined this balance, assigning 61.57% to Hibiscus and 38.43% to Bumi Armada, resulting in an even low volatility of 49.59% and a strong annualized return of 28.13%. These findings highlight that the contrasting business risk, which is a contract-based stability versus the commodity-driven cyclicality, offset each other effectively. It is producing smoother returns and significantly reduced risk compared to holding either stock alone. In summary, the data indicates that both Bumi Armada and also Hibiscus Petroleum were undervalued throughout the period of 2018 to 2022 period, each delivering returns that far exceeded their required benchmark. Bumi Armada emerged as a steady recovery stock with strong alpha and a defensive beta, while Hibiscus proved to be a high growth commodity leverage performance that generated extraordinary alpha despite having one of the lowest systematic risk levels among energy stocks. When combined, the two companies created a highly efficient portfolio with reduced volatility and consistently strong returns. Ultimately, the final assessment is that both stocks offered investors rare opportunities, undervalued prices, strong risk adjustment performance, and complementary risk characteristics. Together, they form an unusual effective pairing that enhance portfolio stability while significantly outperforming market expectation over the 5-year period. That's all I would say from both the stocks of Bumi Armada and Hibiscus Petroleum. Thank you so much.